Multi-leg strategies, straddles and strangles. Most option strategies require you to have a directional outlook to deploy them. However, we'll explore two strategies that can help you navigate any market outlook. Whether you're looking to profit from significant price movements or generate income from neutral markets, learn how to effectively utilize straddles and strangles to maximize your trading opportunities. A straddle and a strangle are similar strategies with a slight variation that can be considered when you expect a sharp move in either direction and an increase in implied volatility, long straddles and strangles. Or expect the underlying to stay neutral and a decline in implied volatility, short straddles and strangles. The key difference is that straddles involve buying or selling both call and put options on the same underlying and at the same strike price, whereas strangles involve buying or selling call and put options on the same underlying but different strike prices that are out of the money. This minor variation in strike prices results in different cost structures and risk-reward profiles, but the fundamental goal of both strategies remains the same. Let's start with straddles, which consist of simultaneously buying or selling a call and a put on the same underlying at the same strike price and with the same expiration date. Now let's dive into the mechanics of constructing a long straddle using XYZ as our example, with a current price of $170. Let's say an earnings event is coming up and you believe the stock can make a sizable move in either direction as there is a lot of uncertainty. This is where a long straddle could be utilized to potentially profit from a big move higher or lower. To create the long straddle, you might consider buying a put option with a strike price at the current price of $170 and simultaneously buying a call option with the same strike price of $170 and same expiration date. If the cost of each option is $5, this results in a total net debit of $10, which would be the maximum risk. The premium paid would be used to calculate the two break-even points of the strategy, which would be the strike price plus and minus the premium paid, $180 and $160. In this example, the stock would have to either decline to $160 or rally to $180 by the expiration date just to break even. This would mean that you must believe the stock will be meaningfully below $160 or above $180 to justify buying a straddle. Conversely, suppose an earnings event is coming up and you believe the stock will stay within a narrow trading range due to low volatility expectations. This is where a short straddle could be utilized to potentially generate income from the premiums collected. To create the short straddle, you might consider selling a put option with a strike price at the current price of $170 and simultaneously selling a call option with the same strike price of $170 and same expiration date. If this results in a net credit of $10, that would be the maximum potential gain. The premium collected would be used to calculate the two break-even points of the strategy, which would be the strike price plus and minus the premium paid, $180 and $160. In this example, the stock would need to remain between $160 and $180 by the expiration date for the strategy to be profitable. However, if the stock moves significantly above $180 or below $160, you will incur unlimited risk to the upside and substantial risk to the downside. Therefore, you must believe the stock will remain within this range to justify selling a straddle. Now let's switch over to strangles, which is a similar strategy to straddles, just with strike prices that are wider apart. Strangles are constructed by simultaneously buying or selling an out-of-the-money call and out-of-the-money put on the same underlying, where the put strike is lower than the call strike, and they both have the same expiration date. Let's first construct and review a long strangle. Let's say XYZ is currently trading at $170 and has an upcoming event, such as earnings, and you believe the stock will make a significant move in either direction. This is where a long strangle can be a suitable strategy to potentially profit from a big move, regardless of the direction. To create a long strangle, you might consider buying a put option with a strike price below the current price at $165 and simultaneously buying a call option with a strike price higher than the current price at $175. If the cost of each option is $3, this results in a net debit of $6, which would be the maximum risk. The premium paid would be used to calculate the two break-even points of the strategy, which would be the put strike price minus the premium paid, $159, and the call strike price plus the premium paid, $181. In this example, the stock would need to either decline to $159 or rally to $181 by the expiration date just to break even. This means you must believe the stock will make a substantial move beyond these levels to justify buying a strangle. Lastly, let's construct and review a short strangle. Let's say XYZ has recently made a big run higher to its current $170 price, and you now believe that the stock will consolidate and trade within a range for some time. This is where a short strangle can be a suitable strategy and can potentially profit from XYZ staying within a set range. To create a short strangle, you might consider selling a put option with a strike price below the current price at $165 and simultaneously selling a call option with a strike price higher than the current price at $175. If the options have a cost of $3 each, this results in a net credit of $6 that will become your maximum gain potential. Similar to a long strangle, the net credit would be used to calculate the two break-even points of the strategy, which would be the put strike price minus the premium paid, $159, and the call strike price plus the premium paid, $181. In this example, if XYZ were to stay between $159 and $181, you would be profitable, and if it were to exceed either of those break-even points, you would experience a loss, including unlimited risk to the upside and substantial risk to the downside. Despite these two strategies sharing a lot of similarities, there are some distinct differences between them, which become apparent when we analyze the Greeks. Straddles and strangles differ notably in terms of delta, gamma, theta, and vega. Straddles, with both options at the money, exhibit higher delta and gamma, making them more sensitive to price movements and resulting in significant changes in delta as the underlying asset price moves. They also have higher theta decay, as at-the-money options lose value more quickly. In addition, with higher vega, this shows greater sensitivity to changes in implied volatility. In contrast, strangles with out-of-the-money options display lower delta and gamma, requiring larger price movements for significant changes in delta, and experience slower initial theta decay, though this accelerates as expiration nears. Strangles also have lower vega compared to straddles, making them less sensitive to changes in implied volatility. In summary, understanding straddles and strangles can significantly enhance your ability to navigate changes in volatility in the markets. These strategies offer a dynamic way to capitalize on market volatility, whether you anticipate a substantial price move with long straddles and strangles, or seek to generate income from neutral markets with short straddles and strangles. By mastering both strategies, you can trade a variety of market outlooks. We hope this video has helped you comprehend these strategies and understand the risks and potential rewards of straddles and strangles. Visit bmo.com/online investing to get started.